Good morning. Glad you could make it here if you're online. Here's a little bit of hope. I just looked at the weather, and a week from right now, there's a calling for a high of 56. So this is a temporary setback. Anyways, so today what we're going to do is we're going to talk about various things. There is a question out there in Learning Catalytics. So if you're just joining us, you should get logged in. The question that's out there relates to last week, and we'll get to that in a minute. But before we get there, I want to talk about Exam 3. Exam 3 is our final exam. It is during finals week. Our exam starts Sunday and goes through Tuesday. The exam starts at 9 a.m. On Sunday, possible 8, I have to double check, and runs until it has to be submitted by 6 p.m. Sunday or Tuesday. So you have 3 days to take it. Now the computer lab is opening up special for us. We have exclusive use of it from 9 a.m. Sunday till noon, and that's to try to take some of the larger numbers to make sure you can get in there. Haley and I will both be proctoring on Sunday, and there'll be 1 or 2 lab proctors there as well. So we're opening up the lab, hoping a lot of people choose to take our exam on Sunday, because you will get the 10-point bonus for taking it Sunday. If you're doing ProctorU, they have spots available on Sunday to sign up for. Schedule with them soon, so you get your choice of time slots. I would also tell you, as long as you schedule reasonably soon, and you go to schedule and say you don't see the time you want or the range of times you want, go ahead and give them a call. On the phone, sometimes they're able to help you beyond what you just see on the screen. So don't hesitate to call them. But to get the 10-point bonus, you have to submit your exam by 6 p.m. on Sunday, and that's Eastern time. And that applies to whether you take it in the lab or on ProctorU. Submit it by 6 p.m. I will add the 10 points in Sunday night. You have a lot of tests finals week, and this opportunity to take it Sunday is a nice chance to say, okay, I'm going to take this one, get it out of the way, and then concentrate on my other finals later. So if you can do that, great. If not, you have Monday and Tuesday to take it as well, but it does need to be submitted by 6 p.m. The final exam is not comprehensive. It covers chapters 9 through 13. I'll be putting out a little bit of information like next week about it, but I wanted to give you a heads up in terms of your own scheduling. So when you're looking at planning for finals week, if you can plan for it Sunday, that's great, and you do get the bonus. But so the final is going to be very much like our other exams. It is not comprehensive, and then it's chapters 9 through 13, but some of those chapters aren't very long, and like for example today, we are not covering every learning objective in the chapter, so some of those chapters are smaller. In particular, chapter 11 and I think chapter 12 also has some learning objectives cut out, so it's shorter. So okay, there's a question on Learning Catalytics right now. It relates to last week. The purchase of treasury stock by a corporation. Oh, let me address those because a lot of people could have. Backing up a minute about the exam. If we go to the lab, it's only open 9 to 12 on Sunday. No, our exclusive use of the lab is from 9 to 12. Other classes could come in from 12 to 6. The lab itself on Sunday is open 9 a.m. to 6 p.m. You can come anytime during then, but they have opened it exclusively for financial accounting from 9 a.m. to noon. But you can come anytime during the day. Sorry, didn't mean to make that unclear. But generally most of the people in the lab on Sunday are our class. So it makes it really nice that they open it for us so we don't have to worry about. Finals week is really weird in the lab. You would think there's no way to predict what day will be lines. There'll be lines there. Some days, absolutely no lines. Other days, horrendous lines, and we don't have a rule of thumb. It just depends what's going on in other classes. So Sunday's a good idea. I wouldn't wait till 4 p.m. Sunday because you could have to wait in line. Because who knows? Generally what we've done in the past, I've done the Sunday finals for the last probably 4 or 6 semesters, and what we've experienced is steady exam taking all day long. So pretty much all the computers are taken. You might have to wait 5 or 10 minutes, but then someone leaves and you get in there. So it's pretty nice day Sunday in terms of being able to take the exam. Okay. There are reservations. Yeah, ProctorU does have reservations on Sunday if you're not, like Haley said. If you don't see it for Sunday, give ProctorU a call, okay? But they will take reservations for Sunday. Okay, so back to the question then that's in Learning Catalytics. The purchase of treasury stock by a corporation increases total assets and stockholders' equity. This relates to last week. And we're going to leave this question open for a few minutes, so if you're just getting here and you're just logging in, don't panic. It's not closing, but I do want to go over the answer. That is false. When we purchase treasury stock as a corporation, we are paying out cash, so assets will decrease. We're also reducing stockholders' equity. So this is actually opposite of what it says. So this one is false. And that Learning Catalytics question is going to stay open for a little while, so if you're just joining us, you can still go in and get it. It won't close on your device for a while. Okay, what's due this weekend? Chapter 11 homework. If you're in Section 3, there's also a quiz for you. You have to submit it by 6 p.m. on Sunday, not start it, but submit it. Okay, so now we're into Chapter 11. Chapter 11, what we've done up to this point is we've worked our way through the balance sheet. We started it with assets in the very beginning. Then we went on to liabilities. Last week we did stockholders' equity. So now we're saying let's take a look at the income statement and and the statement of stockholders' equity. Let's take a look at those statements and delve into them in a little bit more detail. This is one of the chapters we've cut out a couple of the learning objectives. We are not covering learning objectives 2 and 3. So those are already removed from study plan. They will not be on the practice exam. They will not be on the exam. So they've already been removed. You don't have to read learning objectives 2 and 3. The only things having to do with those is you might see some of those words on some of the other problems. So if we don't cover it in class, you don't need it. You will see, for example, learning objective 2 is account for foreign currency gains and losses. Well, we're not covering that, but you will see a line on the income statement for foreign currency translations. But it's just know the line is there, but we don't have to go into calculate it. So we're not doing learning objectives 2 and 3. What we're going to do today is we're going to do learning objectives 1, 4, and 5. And then Wednesday, learning objective 6 is pretty big, and I've got a lot of real-life examples that we're going to use on Wednesday. So today we'll cover the bulk of the chapter, and Wednesday finish up. So just getting started. The first thing we're going to talk about in here is quality of earnings. Now, our reason for issuing financial statements is so that outsiders can use them. And typically outsiders are investors making investment decisions or creditors making decisions about whether to loan us money. One thing they're very, very interested in is our quality of earnings. We call it quality of earnings, and it's basically saying, are these earnings going to continue? And that's what we want to know. Can we expect similar earnings in the future or improving earnings? So when we talk about earnings, we can look at various areas. If you have the PowerPoint slides, you have a few slides after these that go into more detail. But basically, when we talk about components of earning quality, we're saying, is the company using proper recognition of revenues and expenses? Are they following U.S. GAAP? That's important to us. Do they have an improving gross margin to sales ratio? Do they have operating expenses that are declining or stable? Do they have improving earnings, or are they stable? So those 4 things are things that investors look at in terms of earnings quality. So if you have the PowerPoint slides, you have a few more pages of notes that we're not going to specifically talk about. I'm going to talk about these things in just a minute here. Okay, so what I'm going to do to talk about these things is I'm going to look at Amazon's financial statements, and we're going to look at Amazon's earning quality. So this is what an investor would do. First of all, I'm on page 827. So if you want to look at what I'm doing, 827 in your book is this. And that's why I picked this financial statement, because you would all have it. It's relatively easy to find on page 827. Know that this is their 2012 statement. So you could Google Amazon 2012 annual report, and you would be able to find this is their consolidated statement of operations. When it says consolidated statement of operations, that is their income statement. It's another way of talking, another way of calling it, and they don't call it an income statement. The statement of operation is an income statement. The word consolidated means that all of their subsidiaries are included in this. So Amazon, for example, owns Zappos. So Zappos has their own set of financial accounting books, but when Amazon prepares its financial statements, it rolls in all of those other companies that it owns. So it rolls in Zappos, and so that's what the word consolidated means, that they're all rolled in there. So for what I'm doing now, you could look at Amazon's 2012 statement of operation, or you can look at page 827. Nothing I do here do you have to do in terms of calculations. So this is not something you need to scramble to write down all the calculations. But what I'm trying to show you is how we analyze quality of earnings, how an investor might look at a company. And remember, the investor is trying to say, are these earnings likely, is this level of net income likely to continue, increase, or decrease? And we're using 2012 again because you had that statement in your book. So there shouldn't be a lot of writing down. So don't scramble to write down these formulas because you're not going to need them. If you need them, you can look them up. But first of all, let's start with cost of goods sold to sales ratio. So cost of goods sold is an expense. It's typically a company's biggest expense. Now I'm choosing, in this case, to take net product sales to cost of sales. So we have cost of sales given in the financial statement. I'm doing 2012 first. They present in income statements, typically you have to present at least 3 years. So we'll have 2012, 2011, 2010. So I'm taking my cost of sales, which is cost of goods sold, divided by my net product sales. Now there is another line here called net services sales. I'm just choosing to not include that. If we include it, it should work out about the same. And again, there aren't right or wrong answers. But since Amazon's main business is to sell products, and that is largely the larger of the two sales lines, that's why I'm using that. So again, we don't have to memorize how to do this. I'm just saying, okay, I'm going to take their cost of sales as a percent of sales. I see in 2012 it's 0.89. Okay, in 2011, I do the same thing with the 2011 numbers. I get 0.89. And 2010, I get 0.86. So the trend that I can see over time here is this is their cost of goods sold expense as a percent of sales has increased. It went from 0.86 in 2010 to 0.89 to 0.89. So it's not a huge increase, but it's certainly not going in the direction. It's kind of stable, but it's not going in the direction I would like to see. So that one, not a huge cause for alarm, but it's not a positive direction from 2010 to 2012 because we're talking about expenses. So then we go on to look at another part of earnings quality is gross margin to sales ratio. Now gross margin, you should know what gross margin is by now. Gross margin is sales minus operating expenses, or minus sales minus cost of sales, cost of goods sold. So sales minus cost of goods sold. We'll see that later today too. You're going to see it in the income statement. Gross profit, gross margin, same thing. Sales minus cost of goods sold or cost of sales. Okay, so Amazon, when we take the gross margin being sales minus cost of sales, the 5,762 divide by their product sales, we get 0.11 for 2012. If I do it for 2011, I get 0.11 again, and I get 0.14 for 2010. So again, this ratio is not going in the right direction. We're talking about gross profit or gross margin is declining as a percent of sales. So we don't want gross margin to decline. We want gross margin to increase. So this is declining again. It's 0.4 to 0.11 to 0.11, so it's kind of stable there, declining, stable. So still not great, but it's there. Okay. So then another one. Let's look at another component of earnings quality, operating expenses to sales ratio. Okay, so operating expenses are all those things below cost of sales. So this is where they're talking about their fulfillment expenses, their marketing, their technology, etc. So they have 14,446, divide by their sales, and they get 0.28. Now, looking at this, now this is their operating expenses as a percent of sales. In 2012, it was 0.28. In 2011, it was 0.24. In 2010, it was 0.2. This is declining. It's increasing, but it's declining. It's unfavorable because we want our expenses as a percent of sales to be as low as possible. We want it to be stable or declining. In this case, they're going up. They went from 0.2 to 0.24 to 0.28. So this isn't boding well. This is not, we're saying that Amazon does not have good earnings quality. I think I have one more. Operating income to sales ratio. So this is where we're going to take our income from operations and divide by sales, and we get for 2012 0.013. We get 0.0205 for 2011, and then we get 0.0446 for 2010. So again, we're seeing this go in the opposite direction than what we would like. And they all work together, so we would expect and many times for them to work in conjunction. So Amazon's income as a percent of sales is decreasing. It went from 4.6% down to 1.3%. So that is not going in the right direction. So Amazon, if you look at just these 3 years, you would think it would have declining earnings quality. As an investor, when I look at them, I'm going, boy, their earnings quality isn't that great. Now, Amazon has been like the golden child for investors. Amazon went for many years without having any income, and investors have been willing to forgive Amazon for a lot. So investors have looked at this and said, well, other things compensate for it. We're still going to invest. Now this year, interestingly enough, recently, the investing community has gotten a little bit impatient with Amazon. Amazon is a great company. No one's expecting it to go out of business, but investors are getting a little restless because they're saying your earnings quality has been declining, and then Amazon's come out with some pretty big flops. Their Fire Phone was it hasn't gone well. They have not sold nearly enough. They've marked down their inventory. They're now selling them for 99 cents. So that's been a flop. They have a new product coming out called an Echo, and it's like Siri in a room, and you talk to it. And they're saying Amazon's just a little late to the game, and there's other things that they're talking about Amazon for. So investors are getting restless with Amazon, so we'll see what kind of impact it has. But just looking at their earnings quality, 2010 to 2012, it has deteriorated. And so that's when we talk about earnings quality, that's what we're doing. What we're trying to do is look to see if we think those earnings are going to continue. As an investor, I want the company to have continued earnings. So that's just kind of a taste of when we talk about earnings quality. We're trying to predict what they're going to be in. Notice that all these elements of earning quality go down to income from operations and above, okay, because we're looking for things that are ongoing. When you talk about things below that line, we're going to see those not particularly on the screenshot I have here, but we'll see them later today. On items that are below income from operations, they aren't necessarily things that continue, and that's why we split them out. So we'll see that today. Okay, we're going to do exercise 11-15A now. So what we're doing is we're looking at, so we looked at earnings quality. Now what we're going to do is we're going to build an income statement. So today we're going to have a couple times where we're going to have a lot of writing, and this is probably one of them. We have to, first of all, do a multi-step income statement. I thought about first saying, well, let me put up a multi-step income statement model, and then I thought, why don't we just do the homework, and you'll see how this multi-step income statement works. And then the second one is we prepare the statement of comprehensive income. That's a little typically at the bottom of the income statement or a separate statement. So we'll see that as we get to it. So what we have here in the green box are lots of numbers given to us. And like many other times in this class, we don't use every number there. We are preparing something known as a multi-step income statement. And I look down through the list. There's some items on there that do not belong on an income statement. One pops right out at me in the bottom of the first the short-term investments. Short-term investments go on the balance sheet. Okay, so there's things on there that are not on our income statement. But we're told to prepare a multi-step income statement. What that says is a single-step income statement will basically say, here's all our revenues, here's all our expenses, here's our net income. Done, pretty much, kind of. A multi-step says, let's separate out income from continuing operations and then each of these special items that we're going to talk about. And investors want multi-step. So multi-step is what you'll see most of the time. Yeah. Okay. So yeah, I'm trying to think. I mean, I can hear everything in my ears, so it's working. Yeah, Monica, we never have a snow day in here. Yeah, I should have seen, and I don't know what, I'm not doing anything different, so I don't know. You know what I mean? I'm not, okay. So anyway, so now we have we're doing the multi-step income statement for the year. And what we're going to do is we're going to build the statement. Now the top of the statement, what we have is we have the name of the company, the income statement, and the year ended September 30th, 2014. So remember, an income statement has for a period ending. And then the very first line of the income statement is net sales. Okay. So net sales is going to be at the top of every income statement, no matter what kind of income statement it is. Next down, we're going to subtract total operating expenses. Now, what we would do next is we would take net sales minus total operating expenses. So we'll take the $14,300 minus the $12,200, and what we get is a subtotal line. That's the income from continuing operations before income tax. That's the $2,100. And then I put down the next line, which is what I've circled, the income tax expense from the table. You still have Learning Catalytics open. You still have. If you've not answered the first Learning Catalytics question yet, make sure you answer it because it's going to be closing fairly soon. You won't get a specific announcement before it closes. The first question is still open. So if you answered it already, you don't have to worry about it. Okay, after income tax expense, we subtract the income tax expense from income from continuing operations, and what we get is income from continuing operations after tax. And then we have a line called income from discontinued operations. And I'm going to pause for a minute while you write this down. Haley, can you move that one window that's on the total? See how it's covering up? There, thank you. So I'm just going to pause for a minute while you get that written down, and then I'm going to talk about some of those items. Okay, I'm going to walk through the statement, so ignore the question in the chat room because that's going to be addressed as we talk through. Okay. Okay, so now what I'm going to do is walk through. Now we have, let's start at the top. Now that you've got the whole statement, I'm going to start over and kind of talk about each item. Net sales is given to us, pretty clear. We have the total operating expenses. We subtract that to get income from continuing operations before income tax. We do not put brackets around expenses because informed users know that expenses are deducted. So we would always just put expenses, no brackets around them, no parentheses around them. So net sales less expenses gives us income from continuing operations before income tax. Then income tax is just presented, it's deducted because expense is deduction, and we get income from continuing operations. Now, income from discontinued operations, $320 less income tax of $94. What's going on there is, let's say that Amazon, it escapes me what they've sold in the last year, but let's just pretend Amazon sold Zappos. Okay, so if Amazon sells Zappos, there will be, until they sell it, they will have income from Zappos. What we do when we have a discontinued operation, meaning we sold it, is we will list it separately because that's a signal to the investors that we no longer will have this income stream in the future. So when an investor is analyzing our income quality, our earnings quality, they do not use that discontinued operation item. Now, when we do a discontinued operation, you see they had $320 of income from it. What they do is they calculate the tax on the $320, and the tax on the $320 was $94. So they're saying our net income from that discontinued operation was $226. So that one's added in. It's income. It says income from discontinued operations. So it gets added in. Okay, so then we end up with income before extraordinary item. Now, extraordinary item is kind of an unusual thing. As its name implies, we only have extraordinary items if they meet certain criteria. They have to be extremely unusual. Let's say a company had a complete loss of everything due to a catastrophic fire. And they're not located in a place that has forest fires routinely or anything like that. So they would have, let's say for example, a loss, an extraordinary loss, the 12, and then that saves them some income tax. So their net loss is 8. Now notice we have parentheses around this. When we have a loss, we have to put parentheses around it because losses are deductions. Now we don't put parentheses around expenses because expenses, an expense line will always be an expense line and we always deduct it. But when we have items that are gains or losses, you always have to put parentheses around the loss items because we could have an extraordinary gain here, in which case it wouldn't have parentheses around it, it would be added in. So when we have a loss, we have parentheses. Expenses, no, because we know expenses are deducted. And then we have net income at the end of our income before extraordinary items. less the extraordinary loss. So what we're trying to do with a multi-step income statement is we're trying to list everything separately so investors can analyze the earnings quality. They're looking at items that are likely to reoccur. A discontinued operation is not going to reoccur. An extraordinary item should not reoccur. So neither one of those do we want to put in our regular earnings, and that's why they're separate. So this is the income statement that was the multi-step income statement that was called for in the beginning. In requirement 2, it says let's do this statement of comprehensive income. So sometimes companies put this below, and sometimes at the bottom here. See the 1683, the net income we had at the bottom? Notice for our statement of comprehensive income. You want to handle that one? Okay. We start the statement of comprehensive income with our net income as we had it. So that was our net income. Now, think back to the chapters where we had when we had investments. And with those investments, if we were holding those investments at the end of the year and the market value increased or decreased, but we were still holding them, we had unrealized gains or losses. This is where they go on our income. It's on the statement of comprehensive income. So now we have other comprehensive income or loss, and up here we had unrealized gain. Okay, next item down. This is an example. This foreign currency translation gain, again, you just know it goes there. That's one of the learning objectives. We're not going into how to calculate the foreign currency translation gain. It's just in there. Note, both of these are gains, so there's no brackets around them. If either one was a loss, they would have the brackets and be subtracted. So we take the unrealized gain on investments and the foreign currency translation gain, add them together to get our total other comprehensive income. Now the bottom line, comprehensive income, as the word comprehensive suggests, includes everything. Now investors looking for earnings quality are going to be looking net income and higher. They're not looking at these other items, the unrealized gains and foreign currency transaction gains, the same as they do other items. So a multi-step income statement has all these items broken out so that investors can use them as they need to, but they need this information for one thing to analyze earnings quality. There's other things that investors do with it as well. But that's why we have a multi-step income statement, so that investors don't have everything just lumped together. It provides more information for making better decisions. Okay, so we've kind of hit Learning Objective 1. Now we're into Learning Objective 4. Because again, we're not doing Learning Objectives 2 or 3 other than to see like the line on the income statement that we just saw. So now we're on earnings per share. Earnings per share, you need to know this formula. The formula for earnings per share is net income minus preferred dividends over our weighted average number of common shares outstanding. Earnings per share is one of the most widely quoted income measurements companies have. And you'll see announcements about earnings per share. I'll bring in a few on Wednesday. We have two earnings per share calculations. We have a basic calculation, which we're going to do, and then we have a diluted calculation, which if you're an accounting major, you will see a lot more later on, but we don't do diluted here. But let me give you an example of the difference between basic earnings per share and diluted. First of all, basic earnings per share, what we're doing here is we're saying how much income is available to common shareholders divided by the number of outstanding shares of common stock. This is all about the common shareholder. So earnings per share relates solely to the common shareholder. So this is for the common shareholder, which is most of our shareholders. What was our earnings on a per share basis? Okay, so that's why in the numerator we take our net income, subtract the preferred dividends, because we're looking at how much income is available to the common shareholder. Well, preferred dividends have to be paid before common shareholders are paid, so we have to take out the preferred dividends. And then the denominator, weighted average number of common shares outstanding. Weighted average means if you're given a beginning of the year and an end of the year, you would divide by 2. If you're not given anything, any beginning year or end of year, you can just go with what you have. You'll see that in the homework problem we do today. But it's outstanding. Emphasis on outstanding. We do this based on the number of shares that are outstanding. So that means we would have to subtract any shares that we bought back, or treasury stock. Now, an example of diluted shares is when a company has convertible preferred stock. So let me back up. Let me give you an example. Crocs, and I think I talked about this before, a few months ago, Crocs has been struggling financially, and they want to invest in some new technology and do some new things to try to expand their line out from their traditional shoes. And so they needed money. So Blackstone Investor Group came in and said, we'll give you $200 million. In return, you give us preferred stock. So Crocs hopefully will take the $200 million and invest it and turn themselves around. Now the investor group wanted preferred stock because they're not totally sure Crocs is going to make it. So if Crocs liquidates, the Blackstone group gets any money before any shareholder gets a dime, Blackstone gets money back, right? So Blackstone was protecting itself by saying, give us preferred stock because we're not sure things are going to go well. This way, we're ahead of all those common shareholders in case of liquidation. Okay, but Blackstone at the same time says, we're really hoping that this $200 million we invested in Crocs turns them around and they start making money like crazy. And we want to be able to share in that. So what they got was they got this $200 million of preferred stock, but it's convertible preferred stock, meaning that if Crocs does really, really well at some point in the future, and it's all defined in the stock they have, Blackstone Group can convert their preferred stock into common stock and become common shareholders and get the higher dividend and get a higher share price if that's the case. But they have the option of doing that. Those are called convertible preferred shares. So those convertible preferred shares are not common shares right now, so they're not in that denominator under basic earnings per share. But when a company does diluted earnings per share, what they do is they say, okay, let me look at all my convertible shares out there, pretend that they were all converted, and come up with a larger common shares outstanding number. So the diluted earnings per share is a more conservative figure. It will typically be lower than the basic earnings per share. We're not doing diluted earnings per share here, but I wanted you at least to know what it was. Now if you have the PowerPoint slides, you have a few slides that basically say what I just said. I'm not going to cover those specifically, but we're going to do an example here and then we'll do a homework problem as well. Okay, so we have an example where we have a balance sheet that has preferred stock on it. We're given this information. So the preferred stock is $20 par value stock, 2%. Remember the 2% refers to the dividend it pays. Every share of preferred stock pays 2% at $20. We have 11,000 shares issued, so the total par value on that preferred stock is $220,000. The common stock, $250 par, 1,100,000 shares issued. And then treasury stock. Remember treasury stock, when you see treasury stock, it's our own stock we've bought back. And then it tells us during 2014, the company earned net income of $6,200,000. So compute earnings per share for 2014. So we have to do a couple calculations. First of all, we need to compute the preferred dividend. And the preferred dividend is going to be the par value of the preferred stock times the preferred stock rate. So up there, the 2% times the $220,000 gives us $4,400. So we need that. So that's the number we need when we do the earnings per share calculation. It's net income minus the preferred stock dividend. That's what we just calculated here, the 4,400. And then the weighted average common shares outstanding. There's no beginning of the year or end of year to do any averaging, but we do need to get our outstanding stock. We're given issued shares of common stock at 1,100,000. That's issued. Outstanding means we haven't bought them back yet. We bought back 120,000 shares. So to get our outstanding shares, we would take the 1,100,000 and subtract the 120,000 treasury shares. So our outstanding stock is actually 980,000. What we're going to do on the next page is we're going to calculate earnings per share. And when we do that, we need this number here, the 6,200,000. That's our net income. And then we need those two other numbers, the preferred stock, the preferred dividend, and the outstanding shares. So the 4,400 and the 980,000 shares outstanding. Okay. So next page. Okay. So our formula that we just said before for earnings per share is net income minus preferred dividends. So my net income is 6,200,000. My preferred dividends I calculated as $4,400. And then my common shares outstanding is 980,000. So then if I divide that out, I get $6.32. And that's my earnings per share. That's my basic earnings per share. And when you have this on the homework, it says to round to the nearest two decimal places. So use the 5-4 rule. If that last decimal place is a 5 or higher, round up. 4 or lower, round down. But you need 2 decimal places in your final answer. If it's not specifically in there, you can read it. I don't necessarily have a slide for everything, and I've probably combined it with other ones as we've gone. Okay, so now we have a couple questions, and these should be interesting responses. So the first one, true or false? Publicly traded companies have the option to produce audited financial statements. True or false? So this is in Learning Catalytics. You do need to answer it. Okay, true or false? Publicly traded companies have the option to produce audited financial statements. Another 10 seconds or so to get your answer in, true or false. And many of you are probably going to be surprised by the answer. Point out the 980 is not a dollar figure, it's number of shares too. Okay, we're going to close this. And the answer is false. Now let's talk about why it's false, because the majority of you answered the other answer. Publicly traded companies, this is a very close reading. This is part of the pay attention to detail. Publicly traded companies do not have the option. They are required to produce audited financial statements. So they are required to do it. Now let's talk about that, why that is the case. Now, an audited financial statement means you have an independent auditing firm come into your organization and look at all your financial data. It looks at your processes, your internal controls, all of that. And they issue an opinion as to whether those financial statements represent what really happened. Now, let's think about Amazon, for example. Let's say I'm an investor and we didn't have this audit requirement. So Amazon is a mammoth company, and I know about it. I can observe they bring packages to my door, and so I hear about them in the news and I look at it and everything. Okay, so if we didn't have audited statements and I were an investor, I would say, oh, maybe I want to invest in Amazon. So Amazon says, look at our income statements. Now keep in mind, if there were no auditors, it's up to Amazon to report right. So Amazon could do a couple different things. If no one was looking at it, I would have to know that everyone in that organization that had input into those financial statements was following the rules to prepare those statements. So starting with the clerk that enters it all the way up the organization to the CEO and the board of directors, that they all want to present everything absolutely right and they all know the rules and they all follow them and there's no errors. So as an investor, I would just have to go on faith. Now so many companies, if given that option, would just lie. Okay, flat out lie or make mistakes. And it could be inadvertent. But if there's nobody looking over their shoulder, there's no checks and balances to make sure they do it right. There is no watchdog. The auditors form a vital watchdog function. Your stock market system would not exist or could not exist on such a large scale if we didn't have auditors, because I as an investor have no personal knowledge of Amazon. It's not like Amazon's inviting me in to say, oh, come look at our accounting systems. Let me see. Come on, look and see. You can test it yourself. That's not feasible. I don't have the knowledge and I don't have the insider information. So auditors are those watchdogs. They go in there and they test things. They don't test every single transaction, but they do statistically valid samples to make sure things are going according to the policies that are in place, the laws and regulations Amazon's subject to, and that they're following generally accepted accounting principles or IFRS, and that things are going, that the financial statements represent fairly what's really going on. So I as an investor say, oh, there's an audit, I can rely on these statements. Now that's not to say that mistakes aren't made or that fraud doesn't occur, but it's a lot less likely when we have audited statements. So publicly held companies, which are governed by the Securities and Exchange Commission, the SEC, are required to have audited financial statements. Okay? So this one is false because they are required to have audited financial statements. Okay, so one more. Okay, publicly traded companies have to file their financial statements with the IRS. True or false? Okay, publicly traded companies have to file their financial statements with the IRS. True or false? Okay, get your answer in. We're going to close it in about 10 seconds, and I would hazard a guess that most of you are going to be surprised by the answer. Okay, publicly traded companies have to file their financial statements with the IRS. True or false? This one's false. So let's talk about, and a lot of people got it wrong. So let's talk about this. Again, this is, okay, a publicly traded company has to issue audited financial statements. We're not quibbling that at all. That's with the SEC. You file your statements with the SEC. Okay, financial statements. And financial statements are governed by U.S. GAAP or IFRS, but financial statements are prepared according to accounting pronouncements, rules, and regulations, that whole accounting framework. Okay, so those are financial statements. The IRS, every company, publicly held or not, every corporation is required to file a tax return. Okay? Notice I said tax return. You do not file your financial statements. The IRS exists to take tax returns from you. Tax law is formulated by the legislators. Tax code is formulated to gather revenue for the government to operate. So when they pass tax laws, their objective is to raise revenue for the government. So when they do all this analysis, they're analyzing how much money they're going to get and which people have to pay or which corporations have to pay and the impact of that. So tax code is designed to gather revenue. Accounting, like US GAAP, is designed to provide information for investors. Accounting framework is designed by people who know accounting and investing community and what's needed to run investments. The tax code and accounting framework are very, very different. Your tax return is not a financial statement. So companies file their tax returns, not their financial statements. Financial statements are issued to the public and are provide information for investors to make investments, either investor decisions or creditor decisions, things like that. The tax code is based on some of the information in financial statements, but your tax return is not a financial statement. Now, that said, if you're a little organization, so you're not publicly held, maybe a sole proprietor, and you've been operating all along, you probably don't have an auditor because you're so small, it's just you or just you and one person. A lot of times if you go to the bank and want a bank loan, they'll say, give us your tax returns. So banks will use tax returns for very, very small businesses as a proxy for their financial statements because nothing else exists. But the publicly held corporations, their tax return is not their financial statements. These are two very different things. If you're an accounting major, you're going to take tax class for 1 or 2 semesters that focus on tax law, which is absolutely mammoth, which is not financial accounting at all. It doesn't seem to resemble it in many cases. So this one is false. Now, this one, I'm going to go silent for a minute because I want to explain about this. You have both of the things noted on the screen are homework problems. The first homework problem, short exercise 11.3, that's what I have the red box on. That homework exercise is constructing this financial statement. Now, I don't want to go through this financial statement again because it's very much like the first one we did. It might have a few other lines, but I think it's very, very similar. So if you want to copy that down, notice that this income statement is short exercise 11.3. We're not going to particularly focus on that. I'll let you write it down. And then what we're going to do is we're going to be calculating earnings per share using this statement. Okay, so that's calculating earnings per share is short exercise 11.9. So I'm going to pause for a minute, let you write the statement down. I am going to talk a little bit about the statement, but then we're going to move on to the earnings per share. Okay. Again, if you're online, I'm just waiting for people to write this down. still copying this down. So we're still here. I'm going to start talking through this one. I'm not leaving the slide quite yet. So we start at the top of the income statement, and we do our net sales revenue minus cost of goods sold, and we get our gross profit. Gross profit is also gross margin, same thing. And then we subtract our operating expenses. I'm inserting the underlines as we go. So we take the $124,000 minus $65,000 gives us $59,000 of operating income. And then we subtract our losses, and we know this is a loss because it has brackets around it. If it had said other gains, we would be adding it in. And then we have income from continuing operations before income tax. Now, income tax expense, we're told it's 35%. So we take 35% of 40,000. So 35% of 40,000 gives us this 14,000 figure here. So we have to calculate the income tax. So we take 35% of the 40,000, get 14,000, and then we subtract the income tax expense, and we get 26,000 as our income from continuing operations. Next up, we're going to subtract our loss on discontinued operations. How we get the 8450? We take the 13,000 loss and subtract the income tax savings of $4,550. We can deduct losses on our taxes, so we save taxes, and that's why we show it net of tax. So we're going to subtract the loss, and again, we put brackets around it because it's a loss and we're deducting it. And then finally, income before extraordinary item is the $17,550. We're going to add our extraordinary gain. Our extraordinary gain is $3,000, but we'll pay tax of $1,050 on that. So we will have $1,950. We will add to the $17,550 to come up with our net income of $19,500. So that's walking through short exercise 11.3. It's just putting together the income statement like that. Now what we can do is we can actually do this exercise, short exercise 11.9. And short exercise 11.9, see where income from continuing to operate, this right here, that line I've circled, the 26,000, that is on this page. So what I'm doing is I had to get rid of some of the page so I could write. So I have replicated this part of the statement on the next page. So everything from here down is where I'm starting on the next page. So if you've already written that, that's what the black stuff is. So what's in red is what we're doing now. The problem says to compute the earnings per share. Well, what you have to do is compute earnings per share on each item here down. So the first item, earnings per share, income from continuing operations, we take the 26,000, subtract the preferred dividend. Now where did I get the preferred dividend? It's given in the problem. I circled it above, and then I'm going to divide by my common shares outstanding, 10,000. I don't have to weight it because it just tells me this was what was outstanding this year. So my income from continuing operations, earnings per share, is $2.10. So again, that top third of this page was the bottom third of the statement from the prior page. So what we're doing is we're walking our way down the statement and calculating earnings per share on each of these items, starting with income from continuing operations. So our next one is we're going to state that loss on discontinued operations on a per share basis. Okay, so this one's going to go away. They will all appear on the screen at the end, by the way, so if you didn't get one number, I'm going to come back and have them all listed. So next up, that loss on discontinued operations, we take that 8,450 divide by 10,000, that comes out to be 85 cents per share loss. And again, I have parentheses around it because it's a loss. And we keep working our way down. So the next item down, income before extraordinary item, I'm going to take the 17,550 minus the 5,000. I have to subtract the 5,000 preferred dividend wherever I'm looking at income, because we're always looking at income. So if it refers to an income figure like this one, I have to subtract the 5,000 preferred dividend. Divide by the 10,000 shares to get $1.25. Since it's income, I don't put brackets around it. It's an addition. Okay, next item down, extraordinary gain. Again, the gain divided by 10,000. So if it says income, we have to subtract the 5,000. Otherwise, you just divide everything by 10,000, the number of shares outstanding. So this is 20 cents. Okay, so what I've got here then is the final line, net income, 19,500 minus the 5,000 divided by 10, or $1.45. And so then that recaps all the lines up to this. So if you missed any of the red ones, everything's on here for the earnings per share. So this exercise was calculating earnings per share starting at income from continuing operations. We calculate each item on each individual item for investors. And that's it on that exercise. So that was actually short exercise 3 and short exercise 9. Now we're going to do another question. Okay, earnings per share is the amount of a company's net income per share of its what? Preferred stock, treasury stock, outstanding common stock, or total stockholders' equity. And this question's out in Learning Catalytics right now. Earnings per share is the amount of a company's net income per share of its what? You have about 10 more seconds to answer. Okay, earnings per share is the amount of a company's net income per share of its what? Okay, and that would be outstanding common stock. We don't have to have the word outstanding in this particular case, but no, when we do compute earnings per share, it's always based on the number of outstanding shares we have. Earnings per share never includes preferred stock shares. It never includes treasury stock shares. And earnings per share doesn't have anything really to do with total stockholders' equity, so that's why that one's wrong. So what we've done today is we've gone through Learning Objectives 1, 4, and 5. On Wednesday, we're going to do Learning Objective 6, and then I'm going to bring in some examples of what we've been talking about. So that'll be it for today. Stay warm, and I will see you on Wednesday.